David, I think that it's interesting to see. It's only temporary, I think. Obviously, it can't go on forever. But the 10-year yield's telling us, whoa, not so fast. This Trump election, yes, it might be great for growth. It's going to be good for the markets, but it also could be inflationary, especially with tariffs and the likes. So isn't it funny to see the Fed take this dovish short-term tone while we've got that 10-year yield maybe taking a more hawkish long-term tone?
You just nailed it, Scott. And I don't know why logic doesn't prevail in so many other commentaries out there. When you see the long end of rates going up, the Fed has no ability to affect this. This is the bond market. This is investors that are saying, we don't believe you. We're going to demand a higher premium on the future. We need, in order to take that much risk on U.S. dollars with all this printing, you're going to have to pay us more. And so the U.S. is going to need to be really cautious here as we begin to move forward. Because as you know, we have to bail things out potentially in the future. And I do think that there are some challenges coming. We've got both inflation happening right now, but then we've also got the great challenge of economic challenges that might cause more money to be printed, which then leads to greater inflation. So I see greater inflation here on the horizon. And I believe that what the Fed's doing right now is the equivalent of what happened with Arthur Burns in the 70s when we first saw this major entrenchment of inflation. And it took somebody in Paul Volcker having to rack the rates up to over 20% by September 1981 in order to just stomp these embers out. I mean, if you've ever been camping and you got those embers on the fire and a good wind comes and picks up, it doesn't matter if there wasn't a fire a minute ago, those embers could easily ignite again. And we have so much inflation in our nation right now. This new administration, I think, though, is aptly equipped to deal with it. But the Fed is doing no favors right now by dropping rates because this is just going to cause, record highs again in the stock market, record highs again in real estate. We don't have, the consumer keeping up with the income, though. And, we've got Jay Powell out here. He's going to tell us everything's just fine. But you'll notice in his speech that he's going to say that we are not trending or he'll take out that we've made significant improvements towards 2%. They recognize this is a trend.
All right. I agree with you. And so I've said this a few times today. I'll say it probably almost every day all next year, I think. But we've got a problem. Obviously, it's the debt, right? And we're going to go through 36 trillion by the end of this year. So that would have made, in this calendar year, we've gone through 34, 35, and we'll hit 36 in December, I think, sometime. That's the expectation. Anyway, we're gonna see rates higher because of that. Because everybody, like you said, everybody knows we're going to have to borrow money and we're going to have to sell bonds. Well, if you're going to sell bonds, people aren't going to be buying them for, a great price because they know you're going to have to sell them anyway. So they're going to drop their hands, get them for a cheaper price, which means yields are higher. That's number one. Number two is you're going to, all at the same time, you're going to have a Fed that's leaning dovish because they're going to have to try to monetize the debt to get us out of our problem, number one, and keep rates lower because we've got an annual budget deficit. And part of that is the fact that we have a $1.1 trillion debt service on our debt every year, that they're going to want to try to keep that down too. So what is happening when we've got a Fed that's going to be keeping their foot on the gas maybe longer than they should do? At the same time, we've got decent growth. And you've said we might have some problems. We're going to have to print because of that. I mean, Paul Tudor Jones, Jim Rogers, Stanley Druckenmiller, all are saying all roads lead to inflation. And I think that's what you let off with.
Absolutely. I mean, Warren Buffett's sitting here in a ton of cash because he knows this is coming. But here's one fear that I have, Scott, and no one's talking about this. There's three major credit ratings out there. We were downgraded in 2011 when we exceeded 100% debt to GDP and we had political stalemate. We were downgraded in July last year by Fitch. Now Moody's is the last one. Are they going to get moody on us when we start printing again as our response to whatever challenges that we're in? If we go from AAA to AA, there's room now for something to be more valuable. The BRICS nations are coming out with a currency, I believe, which is their retaliation to our inflation that we're causing. And they're saying, hey, 40% gold backed. If you're a fiat currency, we're going to not give you one for one like we did before. Right. We're definitely, the U.S. is the world's reserve currency, but I fear that the 10-year Treasury loses the world's reserve asset class status.
And the Treasury market's bigger than the equity market. We got to listen to what the Treasury market's telling us. Thank you very much for being on, David. See you again.